Hello and welcome to this webinar on social investment tax relief with Big Society Capital and Neil Pearson, who's a tax specialist with Mills Reeves. The social investment tax relief is approaching its third birthday in the summer of 2017, and we're seeing more and more charities and social enterprises that are making use of the tax relief, which is absolutely fantastic. Now, Big Society Capital has played a significant role both in the launch of the tax relief and in encouraging charities and social enterprises to make the most of the relief now that it's here. We've done this in a few different ways. So last year we ran Get It, the campaign, which was to raise awareness of the social investment tax relief and to provide some support to organisations looking to raise investment using the relief. We've run lots of different types of SITR events, and there are more coming up this year. And we produced resources, including this webinar, which we hope lots of people will find helpful. So the presentation that we're going to run through today gives an introduction to the tax relief so that charities and social enterprises and the advisors and other professionals who will be working with them can understand some of the technical aspects in a little bit more detail. And for those of you who are probably more familiar with the relief, you might be aware there are some changes to the scheme that are coming up in the pipeline, including changes to the amount of investment that can be raised, and we're going to touch on that too today. So now I will pass over to Neil Pearson from Mills Reeves.
Thank you, Camilla. Hi, as Camilla mentioned, my name is Neil Pearson. I'm a partner at Mills Reeves and specialise in tax reliefs around investments into businesses and particularly social investment tax relief. So I'm going to run you through the key features of the tax relief, but since I am a lawyer, before we start, I can't but help resist putting in a bit of legal small print, which is really just a reminder that SITR is a pretty fiddly, complex tax relief in detail. So the purpose of this is very much to provide a guide, an overview to help you understand the key features. But it is not a detailed note. So if you do get into the detail about trying to claim the relief, it's obviously worth speaking to your advisor. And before I dive into the detail as well, the budget, the election and Brexit, it's worth remembering SITR, as Camilla said, was introduced in 2014. And in those days, we had a coalition government, which looked quite likely to get re-elected, and the UK was a key constituent of the European Union. We're now in a very different environment. As Camilla mentioned, some material changes were proposed to the rules relating to SITR in the 2016 autumn statement and in the budget in March. But the government's run out of time to actually implement them. So in these notes, I'm going to assume that the changes we were told about by the government will be made, but are likely to be made after the election. But when they are made, they will be backdated to the 6th of April. And there's also been a lot of speculation around, obviously, Brexit in lots of ways, but in particular around the way in which it impacts on tax reliefs, which are state aid, such as social investment tax relief. Some have suggested that the moment that we leave the EU, we will be free to set whatever limits we wish and will no longer need to obtain consent from Brussels. That may well be the case, but nobody knows for sure. The government has announced a wide-ranging review of the various tax reliefs that support investments into businesses, including social businesses. And chances are that review is going to be published pretty much at the same time as we leave the EU. It's probably going to take a couple of years to sort out. So as I say, what you're about to hear is an explanation as to how SITR works now, but assuming that the changes we've already been told about are going to be brought in, but brought in backdated to the 6th of April this year. So let's start with the big picture. What is SITR, Social Investment Tax Relief? Well, fundamentally, it's a way in which social enterprises can raise funds by way of investment and attract investors by offering them tax relief. And this is designed to help fill the funding gap for social enterprises who can't source revenue from other sources such as banks or other lenders. And in essence, it works like this. An individual invests money into a social enterprise, and in return for that money, they get shares or they get a loan. The individual who's put the money in claims tax relief on the amount invested. The social enterprise then takes that money and applies it in support of a trading activity. And after 3 years or longer, that investment is sold or repaid to the investor. Now, there's a key point here, and I'll make no apologies for the fact that I'm going to repeat this a number of occasions throughout the webinar, which is this is a tax relief to support trading activity. It is not a general tax relief like, say, gift aid for charities that simply supports any form of giving or contribution to social enterprises. This is very specifically a tax relief that supports businesses. So, moving on to the tax relief themselves. If an investor comes to invest in your social enterprise, what are the tax reliefs going to look like? Well, for start off, the key tax relief is that an individual who invests can claim 30% income tax relief. In other words, they invest £10 and can claim £3 back. And there is a carryback facility for investments made after 5th April 2015, which means you can treat it as if you had made the investment in the previous tax year, which enables you to get your tax relief quicker. Secondly, an investor under SITR can claim a deferral of other capital gains tax liabilities. If an investor has made other taxable gains and then reinvests those gains into an SITR qualifying investment, the capital gains tax liability that they owe on that other gain is deferred until the SITR investment is sold or disposed of. And then the last key tax relief under SITR is tax-free capital gains. If you were to invest in shares in a social enterprise and sell them for a gain more than 3 years after you invested, the gain that you make should be free of capital gains tax. So those are the tax reliefs in outline. Let's just look at a couple of examples to illustrate how that works. Let's take the example of a community interest company that wants to raise £100,000 by way of a loan to refurbish its premises and expand its operations. So it approaches supporters, and we find 10 individuals who each conveniently offer to lend £10,000. Our social enterprise is offering 5% per annum by way of interest and asks that it doesn't have to repay the loan until the 5th anniversary of the date the loans are made. So our 10 investors agree, and each investor lends £10,000. So what do they get by way of tax relief? Well, for starters, they invest £10,000, they can claim £3,000 back from the taxman. In other words, they can reduce their income tax bill for the same tax year by £3,000. So the net cost to our investor of investing £10,000 is in fact £7,000. Then each year over the life of the investment, our investor receives £500 in interest, which is taxed. So let's say it's taxed at 40%. So we have net interest of £300 a year. And at the end of 5 years, the loan is repaid and the investor receives back his or her £10,000. So for a net investment of £7,000, our investor gets back not £10,900 as the slide suggests, but £11,500, which is the £10,000 plus the interest on top after tax. And our investor has supported the growth of our community interest company. I also mentioned that investors can claim capital gains tax deferral. So let me just explain how that works. Let's say our investor is a relatively well-off individual who's made other capital gains. Let's say that she sold some other shares and made a gain on those shares of £10,000. Well, ordinarily, our investor would owe £2,000 capital gains tax on that gain because capital gains tax is payable on other shares at 20%. But if our investor lends £10,000 and claims SITR, she doesn't have to pay the £2,000 capital gains tax bill now. It's deferred. It's just left outstanding until the SITR loan is repaid in 5 years' time. So in effect, our investor is treated as if she's received a £2,000 interest-free loan from the government. And when the SITR loan is repaid, if our investor then makes another SITR investment of £10,000, the £2,000 tax bill is deferred again, and so on and so on. So for potential funders of social enterprises, this is a highly attractive tax relief. It puts social enterprises on a level playing field with companies in the private sector that can attract investment through the Enterprise Investment Scheme. But one key point here is that unlike EIS, under SITR, you can claim tax relief on loans as well as investments in shares. So we've seen an overview of the tax relief. we've looked at examples of how the tax relief would work to an investor. We now come on to what is a social enterprise, because SITR can only be claimed on investments made into social enterprises. Well, the taxman has a very specific definition of what a social enterprise is, and there are 4 categories at the moment. First, charities, and the charity can be a trust or a company limited by guarantee, it doesn't matter. Second category of social enterprise is a community interest company. Those are hybrid companies, kind of halfway between a normal private company and a charity. And again, that can take any form, a company limited by shares, a company limited by guarantee, for instance. Next, community benefit societies, what used to be called industrial and provident societies, can be social enterprises and qualify for SITR, provided they're not registered social landlords and provided that they incorporate in their rules some form of asset lock. In other words, a block that stops the shareholders or investors stripping assets out. And our final category of social enterprise is a so-called accredited social impact contractor, a bit of a mouthful. What that is typically is a special purpose vehicle that is set up to raise finance for a particular project, typically commissioned by some form of local authority or other governmental agency. And that will typically raise debt finance to generate the working capital it needs to fulfill a particular project or social contract. Now, the Treasury have also said that they have the power to designate other bodies as social enterprises. So far, we've not seen any new ones other than a particular form of social impact contractors, but it does give the government flexibility in the future to introduce other categories of so-called social enterprises. Now, why are these categories chosen to qualify for SITR? Well, these are all forms of organisation that are overseen by a regulator of some kind. They all have social missions built into their constitution or DNA, and all are overseen by a regulator. So community interest companies, there is a KIC regulator, community benefit societies are regulated by the FCA, charities regulated by the Charity Commission, and to be a social impact credit contractor, you have to be accredited by the government. And secondly, all of these bodies are subject typically to some form of asset lock or restriction on paying out profits to members. In other words, the profit that's generated and the assets that sit in these vehicles can't be stripped out by investors in the same way that they can in normal private companies. So those are the 4 categories of social enterprise for the purposes of the tax relief. Now, I mentioned earlier that I was going to keep repeating the fact that SITR is a tax relief that is designed to support trading activities. But it doesn't support all trading activities. In essence, any trade can be supported with SITR unless it appears on the list of so-called excluded activities, the naughty list. So there is a list of trading activities which are effectively outlawed for the purposes of SITR. So if you're an enterprise looking to raise finance, you have to look at this list and ask yourself, do you do any of these things? And if you do, and they amount to more than about 20% of your total activity, chances are you're not going to qualify for SITR. Now, the list appears on the slide. It's pretty long. There are 4 in there that are highlighted in italics. And the reason I've highlighted those in italics is not because they're any more important than the others, but it's because those are the ones that have been introduced by the finance bill that was due to be passed by Parliament, but is likely to be passed fairly shortly after the general election. I guess it's worth focusing on a couple of them because I think they have closed down some projects that were on the blocks for SITR. Leasing or letting assets on hire is potentially a problem for, let's say, community halls, village halls, or sports facilities that generate fair amounts of income from actually just hiring out their facilities to other people. Generating license fees or royalties can hit software businesses particularly, so how that pans out is going to be, I think, quite interesting. And nursing homes or residential care homes, the government have said that they are going to outlaw that for SITR, but then are going to introduce some form of accreditation to allow particular nursing homes or residential care homes to qualify. But we don't yet know what that accreditation is going to look like. So for now, we have to assume that investments to support nursing homes or residential care homes won't qualify. So we've seen the tax reliefs, we've seen what we mean by a social enterprise, and we've had a quick look at the trading activities that can be supported by SITR. Now, as with everything, the Chancellor gives with one hand and takes away with the other, and tax reliefs are always subject to limits of some kind. So now let's have a quick look at the limits that apply to investments under SITR. Well, first of all, for an individual investor, they are capped at investing no more than £1 million in any tax year. And that equates to the same investment limit if you were to invest under the Enterprise Investment Scheme. So that's a pretty substantial limit for individuals. But when we look at the limits on social enterprises, the amounts that any individual enterprise can raise, we see that the limits are a bit lower. When originally introduced 3 years ago, the limit on SITR for any social enterprise was around what's now probably £290,000 in any rolling 3-year period. And I say around because the limit is actually calculated by reference to a formula which ties into the exchange rate between the pound and the euro, so it does fluctuate. But at the moment, as I say, the maximum that a social enterprise can raise under SITR in any 3-year period is around that 290,000 limit. And for some time, people have been campaigning to get that limit increased. And the new finance bill that was going to go through Parliament, and hopefully will do after the next election, is going to change that picture. For a social enterprise that has been trading for less than 7 years, then over its lifetime, it can now raise up to £1.5 million by way of SITR. However, there are some strings attached to that because we have to take into account any so-called risk finance state aid. Now, risk finance state aid generally is a bit of a complex area, but in this particular case, risk finance state aid means either where money put in by a venture capital trust, or any investment made by an investor who then claimed tax relief under EIS or CDIS, or has claimed SITR, or finally, any other form of state aid which is designated under EU state aid rules. Now, unfortunately, there is no definitive list as to what amounts to risk finance state aid. So if there's a question mark, then the chances are you probably have to go back to the body that gave you the funding and ask it whether or not it was state aid. But so you have to go back through the history of a social enterprise and look at how much state aid it's received in the past. And once you know that figure, you have to deduct that from the 1.5 million cap to figure out how much you can now raise under SITR. And as I say, you also have to make sure that you've been trading for less than 7 years. Now that 7-year period starts to run from the date of the first commercial sale made by the social enterprise. And that means the first sale made on a product or service market, but excluding test sales. So when did you first generate some income by selling something, either a product or a service of some kind? That sets the 7-year clock ticking, figuring out whether or not you're within our new £1.5 million limit. If the social enterprise that's raising SITR is an accredited social impact contractor, that's a special purpose vehicle that's set up to fulfill a particular social impact contract, the date of the first commercial sale is taken as the date on which the social impact contract was signed up. Now, there is one exception to this 7-year rule, and the exception relates to what are called follow-on investments. In other words, a social enterprise that has been trading for more than 7 years can still raise SITR up to the new higher lifetime limit of 1.5 million, but only where the social enterprise that is now raising that SITR finance has historically received some form of risk finance state aid within the first 7 years of trading, within the first 7 years after it made its first commercial sale. And secondly, we have to make sure that the new monies being raised are being applied for at least one of the purposes for which the old money was raised. In other words, we're kind of raising the money for the same business. If you fulfill those tests, then even if your business has been trading for more than 7 years, you may well qualify under the 1.5 million cap. Now, the position unfortunately gets more complex if the social enterprise that is raising SITR has or has historically had subsidiaries, or has at any time in the past acquired a trade or business, maybe by way of an asset purchase or goodwill purchase from a third party. Now, if that's the case, when we're working out whether or not our business has been trading for 7 years, you have to go back to the date of the first commercial sale made not only by the parent social enterprise that is raising the SITR funding, but we also have to look at the date on which each subsidiary made its first commercial sale, even if that subsidiary has since been sold out of the group. And if our group has at any time in the past acquired any business or trade from a third party, we also have to look at whether that business or trade has historically ever benefited from state aid, has been trading for more than 7 years, and take that into account. And we kind of do the same thing when we're looking at our 1.5 million lifetime cap. I mentioned that you have to take into account any risk finance state aid that has been received historically, and we knock that off the 1.5 million cap. Well, not only do we have to look at risk finance state aid that has been received historically by the parent social enterprise, but again, we have to look at whether any subsidiary, existing or former, has benefited from risk finance state aid, or any business that we might previously have acquired has benefited from risk finance state aid. So we have to do a bit of a trawl through the history where there is a group structure involved to make sure that we are within the rules for our new 1.5 million lifetime cap. Now, I don't want to go on for too long about this, but I think the only way to explain it in practice is to just give a few examples. So if we just start with a simple one, we have a community benefit society that operates a bakery. It's never had any subsidiary or acquired any other trade or business, and it's never received any previous risk finance state aid. Now, we know it sold its first loaf of bread to a customer when it opened its doors on the 5th of January 2006, and it now wants to raise £500,000 by way of a community share issue to investors, and those investors want to claim SITR. Can they benefit from the new £1.5 million cap? The answer is no. This business made its first commercial sale more than 7 years ago. So what that means is that the most it can raise under SITR is around 290,000 in any rolling 3-year period. In other words, this business is subject to the old limit that still exists. Now let's take example 2. Let's take exactly the same facts, except let's assume that our bakery actually only sold its first loaf of bread on the 5th of January 2012. Well, in that example, it can benefit from the new £1.5 million cap because its first commercial sale was made within the last 7 years. So we're still within that 7-year period, and therefore we can benefit from the new cap, which means we can raise more than 290,000. Okay, let's make it a bit more complicated. Let's take again the same facts with our bakery as in example 1. So a bakery that made its first sale in 2006. But let's say that this bakery on the 1st of April 2012 raised £150,000 by way of a share issue, and it took that money to refurbish its kitchens and to buy some new ovens. And some of those investors claimed EIS relief on their investments because SITR didn't exist at that point. Well, this business can benefit from the new £1.5 million cap. Now, we know it made its first commercial sale more than 7 years ago because it sold its first loaf of bread in 2006. But it has received risk finance state aid by way of an EIS investment within the first 7 years after it made its first commercial sale. And we know that our new £500,000 fundraising is going to be employed in growing the same business that benefited from that original EIS funding. So in this scenario, even though this business has been selling bread for more than 7 years, it can benefit from the new £1.5 million cap. However, we do, of course, have to deduct the £150,000 that it received by way of EIS. So the cap is 1.5 less the 150,000. So, example 4. Same facts as example 3, except we are told that our Community Benefit Society has recently acquired a wholly owned new subsidiary that has for a while been operating a small delicatessen. Now that subsidiary opened its first shop on the 5th of March 1999. The subsidiary is not going to benefit from the new SRTR fundraise. All of the new SRTR fundraise is going to the parent social enterprise which runs the bakery. Well, unfortunately, now this structure could not benefit from the new £1.5 million cap, and it doesn't qualify under the carve-out that I mentioned for follow-on investments. Now that's because we now own a subsidiary that made its first commercial sale on the 5th of March 1999. And as I mentioned, in a group structure, we have to look at the date of the first commercial sale of each group company, and we take the earliest date. So in this case, our parent social enterprise that runs the bakery is to be treated as if it had started trading on the 5th of March 1999. And our EIS fundraise took place more than 7 years after the 5th of March 1999. So therefore, this business simply can't benefit from the new 1.5 million cap. Now, these rules, as you can imagine, are pretty complex to apply in practice. As I say, it means that you do have to look at the history of a group if a social enterprise owns or has in the past owned subsidiaries, just to make sure whether or not you can qualify for the tax relief, or certainly qualify to raise more than 290,000, which is the current limit for older businesses. Okay, so we've looked at tax reliefs, we've looked at the trades that can be supported, we've looked at what kinds of social enterprise can claim SITR, and we've looked at the rules around the limits. So let's look at who can invest and claim. Well, first rule, most importantly, is that the investor must be an individual, a real live person, not a company, not a partnership, not a trust. It has to be a person. Although an investor can invest via a nominee that holds the investment on their behalf. Next rule is our investor must be independent. Now, this is a new rule, again, that is being introduced by the Finance Bill that's likely to go through Parliament later in the year after the election, but is going to be backdated to the 6th of April. Now, what this means is for an investor to be independent, it means that she cannot have an existing investment by way of shares or debt in the social enterprise, unless either, if they're shares, they're so-called permitted subscriber shares, shares that were taken when the organisation was first founded, or it's an investment for which the investor has previously claimed SITR relief. So an investor can make serial investments under SITR, but if they held an investment in a social enterprise that they had not previously claimed SITR on, it may well be that they are not independent and therefore cannot now claim SITR on a new fundraise. As I mentioned, that's a new rule that's just being introduced. Now, there are some restrictions on being employed by the social enterprise that's raising the money. If you're an investor, being a partner in a business or a trustee of a charity or a paid director. Those rules are complex and probably beyond the scope of this webinar, but nevertheless, bear that in mind when looking at individuals. And bear in mind also that when we talk about investors, we also have to look at close relatives and so-called associates. So an investor, for instance, can't invest if her husband was a paid director, for instance. Now, the next restriction on individuals investing is that they can't have a so-called material interest in the social enterprise. And material interest here means they can't own more than 30% of the organisation that they're investing in. And we measure 30% by looking at any of voting power, ownership of ordinary share capital, if our social enterprise has a share capital, or loan capital. So if an investor owns more than 30% of any one or more of those things, then they have a material interest in our social enterprise and therefore cannot qualify for SITR. And finally, there's an overriding requirement that any SITR investor can't control the social enterprise. SITR is available as a tax relief to attract outside investment and therefore is not designed to allow controllers of social enterprises to themselves invest and claim the tax relief. Right, we've looked at the tax reliefs, the trades, the social enterprises that can be eligible. We've looked at limits and we've looked at the rules on who can invest. Now let's look at what an investor can get in return for their money by way of an investment. What are the key investment terms under SITR? Well, if our investor invests in shares, the rules are that the shares that they get in return can't carry a right to a return, which is either fixed or which exceeds a, quote, reasonable commercial rate of return. Now, we have no real guidance as to what is meant by reasonable commercial, so if in doubt, test it with HMRC. Ask them. And secondly, on a winding up of the company, if things don't go so well and the company's wound up, the SITR shares cannot rank above any other shares. Now, these rules are driven by the fact, particularly with regards to winding up, that the tax relief is there to subsidise risk. Investors are taking risk by investing in social enterprise, and the tax relief is there to subsidise that. So the rules around winding up are there to make sure that investors who get the tax relief are really taking the highest risk of any investor supporting the social enterprise. Now, with regards to debt, if our investor invests by way of a loan, then there are a few rules again that are designed to ensure that they are taking a risk. First of all, the debt cannot be charged or secured on any assets. There can be no way in which you can take something back or take a pledge or promise from a third party by way of guarantee or security. So the loans are completely unsecured. Again, the rate of return on the debt can't be greater than a reasonable commercial rate of return. And surprise, surprise, there are rules around when you get paid out if things don't go so well and the company gets wound up. And again, on the winding up, all the monies due to the holders of SITR debt must be subordinated to all other creditors, not just secured creditors, every other creditor, although it can rank alongside other SITR debts. And also, if our social enterprise that's raised the SITR funding has a share capital, then the debt must rank equally with the lowest ranking class of share. So in other words, lenders are taking the highest risk possible of anyone who's supporting this business by way of investment. There are a couple of other rules or restrictions around what investors can get in return for their money. First, we can't have in place any arrangements for the investments to be redeemed, repaid, repurchased, replaced, sold, or disposed of within 3 years. So, for instance, a loan cannot become repayable until 3 years and a day after it was made. And similarly, and this is again a new rule that's being introduced in the finance bill that was before Parliament and is probably going to be before Parliament after the election, that the investment can't be part of what the HMRC call disqualifying arrangements. Now, this limitation is really aimed at what the revenue regard as artificial deal structures. And typically these are structures under which more than half of the money invested goes straight out to the benefit of third parties in some way. Typically, where the company that's raising the finance or the social enterprise that's raising the finance isn't actually doing much, but is subcontracting the delivery of whatever it's doing. Or where the trade carried on by the social enterprise might reasonably be expected to be carried on by some other party to the arrangements. And that's typically aimed at scenarios where trading activities have been split out from one enterprise into a number. So we've tried to isolate the qualifying trade from all other trades which might not qualify in an attempt to get around the rules. So, a quick recap. We know how SITR works. We know that individuals, and we've looked at what categories of individuals can invest money into a social enterprise, and we've looked at the categories of social enterprise. And in return for their money, they will claim shares or debt. And we've just looked at the specific restrictions around what rights the shareholder or debt holder might be able to have. That individual then claims tax relief on the amount invested, and we've worked through the 3 key tax reliefs that investors might claim, including particularly the 30% income tax relief. The social enterprise has to take the money and apply it in a trading activity, and we know that there is a list of excluded activities which no longer qualify, and we know that that list is about to be expanded by the government. And after 3 years or longer, the investment is sold or repaid and the investor gets their money back. And again, no apologies for repeating, This is aimed at supporting trading activities. This is not a replacement for gift aid or some other general support for charitable activities. This is a tax relief for investors who support trade. So what does all this mean in practice for social enterprises? And when and how might they raise funds? Well, the first and most obvious question to ask is why bother? Sounds like a load of malarkey. It's quite fiddly and complex. I've just given you a summary of the rules. There's a bit more detail in the legislation. Why bother? Well, there are some very good reasons why you should bother. First, there will be investors out there looking to invest to achieve both a social and a financial return. And any social enterprise that can offer tax relief to its investors to enhance the financial return is going to put itself at an advantage when it's looking for investors. And remember, if this tax relief continues to take off, as it has done to date, there's going to come a point where many social investors might expect SITR to be available. So if you as a social enterprise can't offer the tax relief to your investors, you may find yourself at a disadvantage. And let's look at comparing SITR debt to bank debt. So if you were able to persuade your friendly bank manager to lend money to your social enterprise, well, let's look at how the two compare. Well, to start off, if lenders are getting tax relief, the social enterprise can offer a lower rate of return to investors compared to the rate of return it would have to pay a bank. And investors are still going to make a good return because they're getting 30% income tax relief. So the returns are subsidised. Remember that SITR debt must be unsecured. Banks will only typically lend if they can take security. But that's not an issue for SITR lenders because SITR lenders can't even ask for it. Remember, SITR is patient capital. You cannot start repaying SITR debt for at least 3 years. Investors cannot demand repayment for at least 3 years. So this gives your social enterprise a critical breathing space where it doesn't have to worry about making monthly repayments, unlike bank loans where repayments will start the following month. And with SITR debt, remember, there can be no covenants or rights to early repayment during that initial 3-year period. So that 3-year period is a genuine breathing space because the lenders and investors can't pull the plug in the same way that a bank could. Remember also, lenders under SITR are likely to be more engaged in your social mission, and they're also likely to lend you more than just money. They'll have expertise. They could even lend you time, contacts, advice. Chances are these investors know something about the sector that you're operating in, or they know something about how to run a business well, and they'll want to support you. So in short, if a social enterprise can offer SITR to investors, it kind of becomes a bit of a no-brainer. So that's why you should bother. So where might we see SITR being offered? Well, let's just look at some obvious examples. Charity with a trading subsidiary, a charity which itself carries on so-called primary purpose trading, so trading which fulfills its charitable purpose. Any other form of social enterprise that's looking to raise finance for expansion, for development, for growth, refurbishing buildings, taking on new buildings to enable it to expand. And whether that's startups or more established businesses, but bearing in mind, of course, more established businesses might get caught by the new 7-year rule, meaning that they cannot take advantage of the new 1.5 million cap. Joint ventures. Bigger charities and social enterprises might form joint ventures for specific projects, and those joint venture vehicles might themselves be able to raise working capital by way of an SITR fundraise. And new vehicles being established to take over the running of facilities from local government. More and more facilities are being closed down, moved out of the public sector and into private or quasi-private. Organisations, social enterprises could be set up to take over the running of those facilities and raise much needed working capital to do that via SITR funding. Social impact bonds are becoming increasingly common, a way of raising debt finance, again, to support specific social projects, very much target orientated in terms of achieving outcomes. There are already in existence a couple of social impact bonds that have qualified for SITR, and I've no doubt there will be more. Just one thing to bear in mind around where we might see SITR being offered, And again, this is one of the changes being brought in by the new finance bill that was before Parliament and probably will be again, which is that SITR money cannot be used to refinance existing loans. This is not simply a way of raising money to recapitalise debt. The money has to be applied for the trade in terms of, in effect, generating development and growth. It's probably also worth pointing out that so far the emphasis has been on debt fundraisers. But a social enterprise can offer shares either as well as or instead of debt. And it is possible for shares to be redeemable, provided the redemption date is not within the first 3 years, and that redemption can in itself provide an exit route for investors. But nevertheless, the emphasis today has been more on debt than on shares. Well, sectors, are there any specific sectors? Well, as I mentioned, there's a list of excluded activities, and those are trades that can't be supported with SITR. Well, any other trade can be supported by SITR, but it's possible to see why sectors such as healthcare, assisted living, provided it's in the home and not in a nursing home, or education, for example, are obvious sectors in which investors and larger investors might be interested. And as the limits increase, the 1.5 million that's currently going through Parliament, then bigger projects can be supported by 1.5 million fundraisers. So maybe smaller infrastructure projects might be able to raise some funding from SITR as well as from other sources. And again, I'm going to repeat, this is for trades. This is a tax relief to support trading activities. And in particular, there are some issues around property letting. The Big Society Capital's website has got some notes around issues to do with property businesses generally, but property letting isn't treated as a trade by HMRC and therefore typically can't be supported with SITR. And also, I've been asked on more than one occasion, is just general fundraising itself a trade? Answer, no, it isn't. And where can you get the money from? Well, the starting point is typically friends and supporters, people you know. Social investment finance intermediaries, there are a number of them around, all very good at what they do, and they understand the sector very well, and they know people who are interested in investing in social businesses, so always worth talking to. You might, if you're a social enterprise, look at going to a fund to see if you can get some money from the fund. Well, there are some EIS-style funds already in existence where investors can claim SITR. Social Investment Scotland have raised one. Resonance have raised a geographically focused fund. It was focused in the Bristol region and are now looking to expand that into other areas of the UK. And Social Finance also has a fund which targets improving the lot of children and young adults. So there are some funds already out there, and there are more to be launched during the year, I'm sure. Now, the government has also talked about the possibility of social venture capital trusts. Those are venture capital trusts that could only invest in social enterprises that would qualify for SITR, and where the tax release for investors into the venture capital trust would look much the same. Well, to date, we haven't seen much interest from the government in bringing those rules in, but if they do, then that would be another type of fund to which social enterprises could go and look for SITR type of funding. And again, as the limits are increasing, which we're hoping they will post the election, and we should expect to see more funds being raised because it becomes economically more viable to raise a fund where it can invest slightly larger amounts of money up to our new £1.5 million cap. Crowdfunding, again, another obvious source. There are crowdfunders out there who are already talking about SITR eligible investments, and there will be more. It is a fantastic way of democratising social investment on a wide scale so that smaller scale investors can actually participate in this and support social enterprises. IFAs, there is an increasing movement to get IFAs more engaged in the world of social investment, who in turn might be able to get their clients more engaged. And the more investors we have engaged, the more likely it is that we'll see more social enterprises being able to access that much needed cash. How easy is it to do a deal? Well, the hard part's raising the money, finding the people who want to invest. Actually doing the deal once you've found your investors doesn't have to be complex. It can be. Lawyers will write documents as long as you pay them to be. But it doesn't have to be. One point to just be wary of is if you are offering investments to the public, there are some rules and regulations around doing that. And if you are going to do that, you really need to understand those rules and regulations before you do it, not afterwards. Because if you breach those rules, it can get a bit serious. So SITR doesn't make a fundraising more complex in itself. There's probably a couple of extra bits you have to put in your investment documents. But it may well make it more likely that you will succeed in raising money. And the process for claiming the tax relief itself is not complex. Pre-investment, you can go to HMRC and seek an advance assurance. That's a letter from HMRC that tells you the tax relief will be available. Now, this gives investors and the social enterprise some certainty. Now, I should say HMRC are currently reviewing the whole process by way it offers advance assurance. That review is still subject to consultation, and the government are looking at it, and we're likely to hear later in the year. But I don't think there's any real risk they're going to remove it, but they may well refine it. And after the investment has been made, well, the social enterprise itself has to file a form with HMRC. There are some time limits, so be careful. And that form then enables individuals to claim the relief. And the form can be downloaded from HMRC's website, completed and submitted. So that's all there is to it, really. Again, a recap, just remember, we're talking about individuals investing money into social enterprises by way of shares or debt. Those individuals who invest then claim tax relief on the amounts they've invested. The social enterprise that receives the funding then takes that money and applies it in a trading activity. And after 3 years or longer, the investment is sold or repaid. And I'll say this for the last time, this is a tax relief to support trading activity. And one other final reminder, which is some of the things I've talked to you about here are not yet enshrined in law, but we think they're going to be after the election. Now, as I mentioned at the start, there's a lot more detail. If you want to find out more, well, you can post questions to Camilla at Big Society Capital. There are some further workshops being arranged by Big Society Capital, and also the BSC website has got some detailed information and links to other useful resources, as well as examples of SITR fundraisers. And that's it from me. Thank you very much for listening.